we use something called risk budgeting, which is that we don't rebalance by dollar amount, we rebalance by risk amount. So essentially, if we use a long-term risk horizon, and then our moderate portfolio has typically, on average, maybe 40 to 50% equities. But at the end of the day, we actually budget the risk, of 40% equities into this particular portfolio. We don't target the whole portfolio risk, and then we actually, within that risk, we basically budget the risks of equities, the risk of bonds, and the risk of gold, okay, into this, while maximizing the risk-adjusted returns, okay. And to add some more value from the equity point of view, so if you have the growth portfolio, for example, equities would be a significant part, 70% of your portfolio. So we basically add this thing called smart beta into the equation, which we have actually done for our Equity 100 portfolio. Now, one of the things that we did also was we keep track of the different factors that are happening. China, over this COVID period, has actually been the only, I guess, major country to have economic growth, last year, right? And when we looked at, we use our econometrics and graphical screens, we see that China, since the middle of last year towards the third quarter or so, starting to basically outperform the US, right? And so we thought, from a strategic standpoint, that we would include more than a market cap weight, into our asset allocation for China and China technology, because those seems to be like growth areas. So as a result of that, we basically put it all together and we came up with the core portfolios. And the core portfolios basically give you a kind of a one portfolio, one-stop shop, to basically decide, how much risk you want to take. And then basically we give you a portfolio that caters to this, maximizing the risk-adjusted returns while still managing risk, and then on a long-term basis. Okay, so this is the whole idea behind core.
Typically, both the global and the core portfolios are a multi-asset class portfolio. They're composed of equity, bond, and gold. Both these portfolios are typically used by long-term investors who want to grow their wealth. And depending on your investment time horizon, your risk appetite, your financial goal, you choose different risk levels between these portfolios. Now, typically the global ARI portfolio is used by a more risk-averse investor who really wants to limit the downside and wants to make sure that they have a psychological know-how that my portfolio will not have a drawdown beyond this limit. So it gives them a sense of a more smoother ride. Versus the core portfolio has a relatively stable asset allocation. And what that ensures is that over time, if you are an investor who regularly contributes to your portfolio, you might experience some heavier drawdown compared to the global portfolio, but it gives you that chance that whenever there are drawdowns and if you put more money, you will end up buying more assets at lower prices. So in a way, dollar cost averaging. Typically, when you're trying to invest into the equity market, you can just go and buy, say, S&P 500 or global market index, right? Like IWDA, if I'm not wrong, Richard, right? So you can get like a global exposure without really needing to do much, right? So that's your market cap oriented exposure to the broad level investment opportunity set per se. Now, while that gives you good returns and it will give you market returns, what has been observed is you can actually generate better return if you systematically capture certain risk elements that actually drive returns beyond the beta that you're getting from these market factors where you are investing on a global basis. And this is again different from active strategies. So typically what happens is there is two sides of the story. There is the passive strategy, which is just index investing, where you just keep investing into ETFs and then just leave it there. And then there is the active bucket where there are active managers who try to outperform the indices by stock picking, and there is human element in that where whether they get it right or not is hugely dependent on the ability of the fund manager and all. Now, we have realized that over the long term, all these active strategies, almost 90% of them underperform the benchmark. So rather than using these active strategies, what we try to do is we use rule-based strategies to really capture these risk factors that actually drive returns to your portfolio. And again, we'll cover this in more details in the subsequent slides. But what has been observed is, all these active managers who claimed previously that they have an ability to, pick the right stocks or the right, investment strategies to give you extra return. What actually happened and what actually, in research got proven was, this extra return is basically not independent of extra risk that these managers are taking. And if you can systematically capture these risk elements, then you can actually generate similar alpha, but in a more systematic and a rule-based manner. And that's what I think the smart beta, tries to achieve, where instead of market cap weighting your investments, so if you're investing in, say, S&P 500, the largest market cap will be the highest, weightage in your portfolio, and the smallest market cap will be the smallest weightage. So instead of just market cap weighting, we do the weighting based on these risk factors that really drive returns to the portfolio. And that's how the portfolio actually gives you a better, risk return paradigm and a mix, and gives you a better overall.
Every stock only depends on one thing, one factor, which is the market. If the market goes up, all stocks will go up, but the degree of it going up is captured by this thing called beta. Okay. Now, what Fama and French did was say, look, there's not only one beta, there are several betas. And in the first iteration, they came out with 3 betas. So you have beta 1, which is what the CAPM beta is, which is market risk premium. Okay. Beta 2 is something called small size beta. Okay. Small size risk premium, which is that they basically took the smallest stocks and they minus off the largest stocks. So you get this risk premium for being a small stock, right? Because being a small stock, you actually have more risk, and therefore you should be compensated more for owning small stocks, okay? And then the third thing is what they call value stocks, right? And high minus low is actually high book to price minus low book to price. And so when they actually developed this model, what they found was that this 3-factor model explained more of the returns of a portfolio of stocks than the CAPM model. Okay, so the R-squared basically moved up. Okay, so this is usually the starting point, for factor models.